Hello everyone, my name is C-Brockett, owner of Brockett Financial Services. In today's video, I'll be briefly describing the differences between two money market instruments, stocks and bonds. To begin with, a stock is an equity instrument carrying ownership interest. What that is that you hear the word equity, you hear the word stocks. When you purchase a stock, you now have ownership within that company. But what we gain the interest portion is, let's say for example, today I purchased one share of Apple for $10. And next month, that same share is now worth $15. If I was to sell that share at that point, I will gain 50% profit from my initial investment of $10 plus the $5 remaining, which will be my profit. A bond is a debit instrument from a company with a promise to pay back. So for example, when you purchase a bond, you're lending the company money. So the company will then pay you back the money that you lent plus interest, just like a personal loan. Since we now know that what we receive back from bonds is interest, based upon the amount of bonds that we did purchase, what we receive back from stocks is dividend. So breaking this down, dividend. When we purchase a stock from a company, we hope that that company will perform better over time, which will mean that the profits will grow over time. So each quarter, companies release their own quarterly statements. And regarding the quarterly statements, if the company did perform better over time, the price of your stock will grow for sure. But based upon those profits for holding those stocks, you will receive a portion of those profits, which is dividends. So now that we know that what we receive back is dividends, depending on the performance of the company, we now know that stocks at the high risk, high reward. So let's say, for example, I purchased 10 shares of Microsoft at $100 per share. My investment of purchasing 10 shares is now a $1,000 investment. Let's say Microsoft had a bad outage, and now the share price dropped to $50 a share. Now that means that the 10 shares that I do hold is now worth $500, meaning that I lost out on $500. So, is the rate guaranteed for a stock? No. Is the rate guaranteed for a bond? Yes. But what's good about stocks, the benefits of both of these money market instruments? Stocks, you have voting rights within that company. Bonds, in the case of liquidation of the company going bankrupt, you're paid first before stockholders. That's the difference between stocks and bonds. I'm gonna put that one on here, man.